Hello and welcome to this episode of Standard Deviation, my column and video series. I'm TCA Sharad Raghavan, and today I'm going to be talking to you about what is likely to happen to income tax in the upcoming budget. Now, as the Finance Ministry hunkers down and begins preparing Budget 2025, calls have resurfaced for reducing the tax burden on salaried taxpayers. Unfortunately, this is unlikely to happen anytime soon for three reasons. First, the Narendra Modi government's past tax reforms, the introduction of GST and the corporate tax cuts, haven't really panned out as it had hoped. Second, as a result of this, the government's dependence on income tax has grown to levels not seen in at least 25 years. Third is the nature of income tax itself, at least when it comes to salaried taxpayers. While corporate taxes are paid on profits, once all expenses are deducted, and GST is paid only if a person buys something, a large chunk of income tax is deducted from your salary even before you get it in the form of TDS. This makes income tax such a steady and reliable revenue stream, and an increasingly vital one, that the government simply cannot afford to do anything that would curtail it. Let's start with GST, the Modi government's first major tax reform in 2017. To be clear, the idea of GST is sound and essential for a country looking to attract both domestic and foreign investment. A single unified tax rate nationwide for any given commodity or service is a basic prerequisite for modern large businesses to consider investing. The problem with GST was not the idea, the problem was its implementation. And this is not just about the multiple rate slabs, though that certainly needs urgent improvement. GST's problems also arose from the extraordinary promises the centre made to the states to encourage them to adopt it in the first place. The centre sweetened the GST pot for the states by promising them 5 years of compensation for any shortfall in revenue they faced due to the implementation of GST. At the core of this promise was the assumption that states would have seen an incredible 14% growth in their tax revenues every year, and so if GST resulted in a shortfall in this, they would be compensated. In other words, states were assured a 14% growth in their tax revenues every year, a growth rate far in excess of what most of their past performances should have justified. But they needed to be brought on board, and this promise was essential in encouraging them, so the centre went ahead with it. Former Chief Economic Advisor Arvind Subramanian and his colleagues, in an EPW paper published just a few months ago, calculated that this compensation cost the centre tax revenues amounting to 1% of GDP every year. Incidentally, Subramanian was the CEA when GST was born. What the economists also found was that net GST revenues, once all the refunds were accounted for, have only now reached pre-GST levels. One reason for this is that between 2017 and 2019, the GST Council went on a rate-cutting spree. The average GST rate fell to 11.6% according to the RBI, which is a far cry from the 15.5% revenue-neutral rate Subramanian had suggested in the run-up to GST. Of course, revenues would suffer because of this. If the rates are falling, if the average rates are lower, then your revenues are of course going to be lower. Also, keep in mind that GST is an ad valorem tax. So the higher the rate of inflation and the rise in prices, the higher the GST collections. Yet, even this bump has not really helped. So what was widely expected to lead to a surge in tax revenues for the centre has so far fallen flat on that front. Not really a failure, but GST hasn't been a bonanza either. Then, in 2019, the government implemented its second significant taxation reform, the cutting of corporate tax rates. The hope was that this would encourage companies to invest and expand their business in India, which would eventually lead to higher corporate tax revenues for the centre. The reality, however, has turned out very differently. Private sector investments, while growing, are tepid and nowhere near the level the Indian economy needs. On the other hand, corporate tax's share in the overall tax collections has fallen from around 35% in 2014-15 to a little more than 26% in 2023-24. Things are looking even worse this year, with corporate tax revenues for the April to October 2024 period accounting for just 24% of total tax collections, as economist and ThePrint's columnist Radhika Pandey found in her latest article. In fact, corporate tax revenues have grown only 1.2% this financial year, compared to the 12% growth estimated in the July budget. Now, one could argue that this lower tax collections from companies is because profits have been shrinking. But the thing is, they haven't been. An analysis by Motilal Oswal Financial Services found that corporate profits as a proportion of GDP surged to a 15-year high in 2023-24. Sure, the first 2 quarters of this financial year have seen profits slip, but that's too recent to be a factor. This is something the government needs to examine. Why is it that, despite making profits, corporate tax collections are not contributing as much to the total tax kitty as they used to? Intertwined with all of this, as both possible cause and definite effect, is the government's increased reliance on income tax to shore up its revenues. Income tax accounted for 30% of total tax revenues in 2023-24, up steadily from 21.5% in 2014-15. This year, the number is even higher, coming in at 30.7%. This is the highest it has been since at least 2000-2001. Some of this higher share can be explained by the robust growth in income tax collections. If the government is collecting more from income tax, naturally its share in total taxes would go up. But a large part of the explanation is also because of the relatively poor performance of corporate tax and GST collections. With the economy slowing and the private sector not really stepping up, the next budget will likely see the government again promising a sizable amount of capital expenditure. But if it wants to stick to its commitment to reduce the fiscal deficit, it simply can't afford to make any substantial cuts to income tax. Sorry, folks. But on that note, that's all from me. Thank you for watching.